We'll go ahead and get started. I know people are still gathering, but we'll get through the housekeeping things in order to move through to the discussion. Once again, thank you all for joining us this morning. We're going to be discussing consumer M&A market, getting deals done in 2021. Looking forward to getting to that. But before we do, a couple things to get through. For those of you I have not yet had the pleasure of meeting, my name is Lena Dobrier. I'm the Director of Operations at Opus Connect. We're a lower middle, excuse me, and middle market focused M&A organization, catering to transactional professionals, private equity firms, investment bankers, lenders, independent sponsors. We have a ton of events coming up this year. We're doing close to 250 events in various different formats. Of course, many of you today are participating in our consumer-focused Deal Connect event, where we're pairing up capital providers and investment bankers for one-on-one meetings. We're doing a lot of webinars, Lunch for Six. So if you're interested in learning a bit more about us and how we can help, please feel free to reach out to my colleague, Jacob Zephyrin, or anyone on the team. We'll be happy to answer any questions you may have. During today's panel, we will take Q&A. So as questions come to mind, please submit those in the Q&A bubble. Our moderator will try to get to as many as possible. Please refrain from using the chat and stick to the Q&A bubble. It'll make it easier for us to review. And once again, we'll try to get to as many as possible. I want to give a moment to our sponsors. These events would not be possible without their support. So I definitely want to give them an opportunity to say a few words. David Kogan of Sapient Investigations. David, please introduce yourself and your firm.
Good morning, Lena. This is David Kogan. I'm the Managing Director of Sapient Investigations. We're an international corporate intelligence firm. In the private equity space, we primarily do executive background checks, which means we do all kinds of vetting around deals, whether it's looking at management teams, joint venture partners. We work with large lenders, looking at guarantors. Pretty much provide the kind of integrity to the deals that everybody needs so much. We also have a very robust business dispute division and do a lot of litigation work as well. So when things go bad, we're there as well. Anyway, it's always great to be at Opus Connect. And I look forward to meeting you guys later in the day.
Thank you, David. Voorhees, is anyone in the virtual room from Voorhees? Go ahead and raise your hand. If not, I know we'll be hearing from them later on during the Deal Connect break. They're our law firm partner for this. Excuse me, we hosted a panel yesterday with them as well. So you'll be hearing more from them this afternoon. I do want to briefly acknowledge Assembled Brands, of which Michael Lipkin is going to be speaking on today's panel. So we'll wait until we introduce the panel before we get to the overview of Assembled. But thank you for your support, Michael. And of course, Richard Baum of Consumer Growth Partners. He is today's moderator. But just before we get into that, we have a couple poll questions that we'd like to ask you. So I'm going to go ahead and launch the first one. We'll move through these fairly quickly, I promise. Let us know who you are. Independent sponsor, investment banker, capital provider on the debt or the equity side, service provider or other. Let us know. We'll give it 10 seconds and we'll move on. Okay, so 14% independent sponsors, 57% investment bankers, 14% capital providers on the debt side, and 14% capital provider on the equity side. Thank you guys for participating in that. This is helpful for us to know who's on the call, but also for our panelists to know who they are addressing today. Last question before we begin, and we'll weave a couple others into the discussion. When are you comfortable attending in-person events? Opus Connect, it's now been a year, if you can believe it, since we hosted our last in-person event. It's been a wild ride, but we're curious to know when you're comfortable. Now, not until you get the vaccine, never. Let us know. We'll give it 10 seconds and we'll move on. Great. Huh. So I think this is the first time I've seen this big of a split. 38% are good now, 31% not until you get the vaccine, and 31% again, never. You're good doing the virtual events. Awesome. Thank you for participating. Excuse me. Without further ado, I would like to introduce today's moderator, Richard Baum of Consumer Growth Partners. Richard, the floor is yours.
So thank you, Lena, and I really want to thank everybody for joining, and in particular our panelists for today. Just a brief introduction about Consumer Growth Partners. So we are an independent sponsor, but we're a bit of a hybrid in that we have both an investing platform and an advisory platform. We do focus exclusively on investing in retail and what we define as non-perishable branded consumer products companies in the lower middle market. With our advisory platform, we work with companies, again, in the lower middle market who are not yet ready, willing, or able to take in outside equity capital, but do have a transaction in their future. We primarily work with them on an annual basis to help them get from what is normally less than 5 million of EBITDA to somewhere in the 5 to 10 range so that they can have a more robust process and get better valuation when they do decide to go to market. Today, I am delighted to be joined by some really great panelists. And before I do that, I just want to kind of reiterate what we're going to be talking about today before letting the panelists introduce themselves. And that is the fact that that COVID-19 has really wreaked havoc with consumers in unimaginable ways over the last 12 months. But with the arrival of vaccines, as we saw in this recent poll, there is optimism that life will return to a new, albeit undefined, normal sometime in the next 6 to 12 months. And accordingly, the M&A market for consumer-facing businesses is already showing signs of opening up. And the next 12 months could be rich with activity on both the seller and buyer sides of the market. In putting together the panel today, we wanted to draw from different disciplines. So we are delighted to have Dan Gaspar from TZP Group. Dan is a capital provider. Dan, why don't you do a brief introduction and then we'll move on to our other panelists.
Sure. Hello, everybody. I'm Dan Gaspar. I'm a partner at TZP Group. We are a multi-strategy private equity firm managing approximately $2 billion, focusing on making control and minority investments in consumer and tech-enabled business service companies. We focus on lower middle market companies and are focused on partnering with founders and entrepreneurs who are seeking to retain a significant stake in the business and are looking for a hands-on value-added partner to help maximize the value of that retained stake. We are currently operating out of 3 different investment vehicles, 2 buyout funds and a growth equity fund, but all of our verticals focus on the same sectors and deal dynamics with founders that I mentioned earlier. Happy to be here today and looking forward to the conversation.
Thank you, Dan. Let's move to Michael Lipkin of Assemble Brands, one of our sponsors. Michael, we are delighted to have you.
Thanks, Richard. Thanks, Lena. Happy to be here. So president of Assemble Brands, we provide working capital business insight through data and a network of providers to emerging consumer brand companies. Our primary focus is on direct-to-consumer. We look at companies that are showing strong traction in the marketplace, so 18 to 24 months of sales history, strong run rate. I like to say anything that you can find in your house will probably end up in our portfolio. So we have a wide breadth from food and bev, cosmetics, apparel, etc. So really excited to be here. We've seen, tremendous growth, obviously, with COVID-19, both in our companies that are in the portfolio and just the portfolio overall. And we think this is just the beginning of a long-term trend.
Great, thank you, Michael. Next, Sucharita Kodali from Forrester Research. Sucharita is our subject matter expert. And when we kick it off, she's going to kind of set the stage for us about what is the state of the consumer. Sucharita?
Yeah, for those of you who may not know Forrester Research, Forrester is a technology research company based in Cambridge, Massachusetts. I've been an analyst there for 18 years, focusing on the retail and consumer sector. I work with retailers, brand manufacturers, and a number of solutions providers like technology companies and software vendors that support that ecosystem. Great.
And I can clearly say last but not least by any means, Billy Sussman from Threadstone. Billy?
Hi, I've been doing M&A advisory for 25, 30 years at prior firms. Threadstone launched around 10 and a half years ago, working exclusively advisory on the consumer retail side with private companies, public companies, and private equity firms.
Great. Thank you, Billy. So I'm going to turn it over now to Sucharita, who's going to walk us through a terrific presentation on kind of what is the state of the consumer. The consumer, as we know, has really changed a lot of shopping behavior and other behaviors over the last 12 months during COVID, which she has captured and wants to share with us now. So Sucharita, I'll turn it over to you.
Yeah, and we can go to the next slide. So one of the things that I think is important to recognize about the pandemic is that even though there are so many media stories about the terrible state of the retail industry, it is important to look at the overall retail spend that the pandemic has actually driven. And it is a larger number actually than ever in US history. Now, on the next slide, there were a few months that were a little bit flatlining, particularly in Q2 last year, but there has been a pretty strong recovery. But of course, the devil is in the details. And when we look at retail, it's really the story of two different retailers. A disproportionate amount of sales have come from a handful of sectors. I call them the two E's. They're e-commerce and essential retail. And even within essential retail, it's grocery, it's general merchandise like Walmart and Target, it's the home improvement retailers. And more recently, we've seen the regrowth in drugstores and car dealers. The downturn has been at the bottom part of this slide. And these are companies that have just really, really struggled throughout the entire pandemic and will likely take at least 2021, possibly some of 2022 to fully regain their losses. We're talking about all of the mall merchants and the restaurant sector that have lost share at the expense of these other companies, particularly in grocery, where they've seen never before envisioned gains. So on the next slide, I also want to point out that a lot of these growth statistics that we've seen in e-commerce may not be long-lived. And two of the sectors that we've seen and heard the most growth about, the online grocery sector and the online restaurant sector, this is sort of tracking through the pandemic, the adoption and the usage of these different approaches, restaurant delivery on the top, grocery delivery on the bottom. Grocery delivery certainly looks like it may be in a better position to maintain some of the share that it's picked up, but even that has seen a slight decline and will likely continue to see decline through much of 2021 as stores reopen, as the vaccine, well, as consumers go back to stores, I should say, as the vaccine gets disseminated. And certainly the restaurant delivery sector, the Postmates, the DoorDashes, they will have seen the biggest drop-offs overall across all demographics. The other thing, the main reason I'd actually pulled this slide was I got a request on what's the age demographic, who's actually using these services, because there were some hypotheses that some older consumers were using these for the first time, that they were driving a lot of the growth. As you can see here, the older consumers are the ones that are least likely to use these. There was certainly growth through the pandemic, but there's also pretty substantial decline as we see things kind of progressing. So the next slide, what I want to talk about are some myths and truths that that I often hear, and I thought I'd share with you some of the data that we have on it. The first is that there's going to be curbside for forever and ever, and curbside pickup, which many of you have probably engaged in, or people in your family have picked up things curbside through the pandemic. We asked consumers, do you think you're going to use curbside? You're going to continue to use curbside even after the pandemic is done? And about, depending on when we asked the survey, it was about a fourth of people in August and ended up being about a fifth of people in November. So you see that slightly declining. I actually think there's another factor on the next slide, which is not just what consumers want. You have to have supply of curbside. And with the exception of companies like Walmart and Target that have leaned into curbside and they have made heavy investments, often to gain market share, the truth is that curbside, particularly, and I mean for grocery stores, this is the big question, where it costs on average about $7 per transaction. This is picking an order, packing it, bringing it out to somebody's car. That's a labor expense that previously consumers had to absorb because it was cash and carry for the most part. And the question is, how many of these businesses are willing to absorb that expense? Because right now curbside is free and people are more than happy to take advantage of it. But if you actually have to pay for the cost of it, the adoption may go down. It will certainly go down. And if the adoption goes down, then the value of merchants offering it also changes. Now, the equation is very different outside of the US, where the cost of labor is lower, but in the US, you still have these high labor expenses that really impede the adoption of fulfillment strategies like this. So second point, next slide, is lots of speculation around video shopping. And the main reason for that is because video shopping is this crazy popular thing in China. And I just want to make it crystal clear that China is not the United States. And on the next slide, I think that one of the things that we often forget as Americans is that it wasn't the Chinese that started video shopping. We actually, as Americans, were the first ones to launch this and create best practices around it. If you've ever visited the QVC headquarters in Westchester, Pennsylvania, they do tours where they showcase all of the data science and the real-time nature of everything that they do. This is an industry which not only was born in the United States, but really developed so many best practices in the United States. So it's not that we need to go imitate the Chinese, rather that we wrote a lot of the playbook. And the bigger challenge is that consumers really haven't adopted video commerce as much in the United States, A, because we have so many different shopping options, and two, we have other entertainment options. One of the things and one of the reasons that video shopping is as popular in China, I will argue, is because they don't have streaming video. They don't have Netflix and Bridgerton there, and that makes a difference in how much they have from a leisure time standpoint, particularly in tier 2 and tier 3 cities where they have nothing but a relatively slow mobile phone connection. So next slide. There is a myth about the speed of delivery. That's been pervasive in the United States for the last several years, ever since Amazon has really tried to push for faster and faster delivery. And there's this belief, this prevailing myth that all consumers want everything right now. Just a little bit of data, which I think is really, really interesting from the pandemic, is only 17% of people say that they're more likely to shop with a retailer that offers same-day delivery. More importantly, through the pandemic, almost a third of consumers said that they received their e-commerce orders late. Now, why does that matter? On the next slide, I would argue that we are pushing certainly for faster delivery, but it's certainly not because consumers are necessarily willing to pay for it, but that certainly has not held back the flurry of ultra fast micro delivery options. There are a number of VC-funded companies here that I showcased for you on this slide. Although I would argue that this may just basically be Cosmo 2.0. If you remember Cosmo, they was a big dot-com flameout in the year 2000, where they were like delivering Snickers bars for free. Not a sustainable business model. Next, the next point here is that this belief that work from home will forever be into the future. The information, there are a number of resources. The information is one that are kind of keeping track of what companies are announcing from a return to an office standpoint. As you can see here, there's only one company here that claims that it will be fully remote. We'll more likely see some kind of a hybrid model. So this idea of permanent work from home is absolutely a myth. However, I do think that it is important to think about how urban centers will shift, because if some percent of workers may only work 4 days a week in the office, you may have up to 20% of the vehicle miles traveled on particular days, or 20% lower occupancy in some of those buildings. That could absolutely affect things like the retail footprint that is in those urban centers. So the next slide is that stores are dead, and that stores are going to go away because everybody, of course, is going to purchase online and just shift to curbside pickup. And what we've actually seen is retail be really surprisingly resilient. So only about 12 to 15,000 stores we have seen close through the pandemic. There are more than 1 million retail establishments in the United States. Now, when you have some sectors that have been off by as much as 25%, that means that their revenues have been down worse than their store closures have. Same thing in the restaurant sector. You have estimates, and there's not even really a great scientific estimate of how many restaurants have closed. I think the National Restaurant Association did a survey, and they basically showcased that about 100,000, or they think that about 100,000 of the 650,000 restaurants in the United States closed. I think that that's better than we would have expected at the beginning of the pandemic, for sure. And my last slide here. Actually, my second to last slide. This is one thing to keep in mind about bankruptcies. We do expect the number of bankruptcies probably in 2021 to be higher than they were in 2020. Interestingly, 2020 had a higher number of bankruptcies than we'd seen in a long time. The one thing that I will point out is that a number of those bankruptcies were in really diverse sectors. In the past, you tend to see bankruptcies in apparel, but now you saw it in more than just apparel and department stores. You were seeing them in the beauty space, in jewelry companies, and all manner of retail institutions. And this is my last slide, is the growth of e-commerce. So this is the one that probably is the most controversial, because people think that e-commerce will have leapfrogged, decades in like a few months. And there was I think a 2-month period where you did see a substantial leapfrog. But as you saw, even from my earlier online grocery figures, the restaurant figures, you see a bit of a downtrending again. And where we saw 2020 shake out was that what would have been 19% e-commerce penetration grew to 21%. So we leapfrogged a couple of years, not quite 50. And then every year on out will be, relatively modest gains. We do expect by 2023, about a quarter of all spend will happen in e-commerce. So there you have Forrester's projections. I should have an even more updated version of a few weeks. And on my last slide is my contact information if anyone wants it, on Twitter, LinkedIn, or Clubhouse. If anyone's on Clubhouse, I do a show at 8 p.m. on Thursdays there. So that's my slides.
So that is terrific. Thank you, Sucharita, for kind of setting the stage for this. Love the idea of the myths and half-truths, since seems to be something that we've dealt with a lot in the last year in lots of different venues. So what we'd like to do is to kind of go into our topics. We've got about a half a dozen topics that we'd like to have our panelists comment on. And then, as Lena said, we will take Q&A as appropriate. And we've already gotten a couple of questions, which I have noted. I guess just playing off of your last slide, Sucharita, our question was, how will the massive shift to consumer shopping online, and I guess you might not view it as massive, although I think the popular press does. How does that shift versus shopping in stores affect the M&A market for consumer deals in 2021? And maybe for that, we'll go first to Billy.
Sure.
What are you saying?
It's really interesting what we're seeing in different categories, but fundamentally we're seeing that brands that are digital in nature can kind of garner a multiple of revenue in a transaction, 2 times, 3 times, 4 times revenue, versus a traditional physical brand or retailer is garnering 4, 5, 6 times Ebitda. So there right now, I think, is a belief that in the investor community that there will be, and Dan should definitely follow these comments, but a belief that the digital customer is wildly more valuable than the physical customer from a transactional standpoint. I think in that same spirit, a little bit addressing one of the questions I noticed in the Q&A, I do think there are buyers that are forming that exclusively buy Amazon brands that distribute 85+% on Amazon. Those are done at a pretty conservative valuation because it is such a captive audience, but probably 9-12 months ago, there were no buyers for brands like that. So I think that the big change is on valuation and the value of that customer. I'll let Dan respond as an investor to the same question.
Yeah, Billy, I totally agree. And it's interesting, look, the shift from brick and mortar to retail to e-commerce is obviously, it's not a COVID phenomenon. E-commerce has been slowly chipping away from retail for the past decade, and COVID acted as an accelerant. To Sucharita's point, it may have been something less than throwing gasoline on the fire, which is probably how I've been explaining it lately. But we certainly did leapfrog at least a few years. And so, if you were a consumer brand with a large portion of your sales at retail, you were already facing headwinds on valuation before COVID. And frankly, the same to your point, Billy, if you had a huge portion of your business through Amazon. And so as we look at consumer brands from an investor perspective, really the question is, how differentiated is your brand? And does your brand own the consumer that's buying? So obviously, we love brands that are digital first on their own e-commerce site because you have all the information, you know who your customers are, you can communicate with them, you can offer them opportunities to expand into different products, you can try to figure out how to improve and increase the lifetime value of that customer. So that's, there's no question that customers who own that, businesses that own that customer are more valuable from our perspective. But you're not going to be a successful brand without having some exposure to Amazon these days. And I think the key is to not rely only on Amazon. What's been really interesting over the last few years, but in particular over COVID, is how brands have used these massive shifts to find new ways to connect with their audience and to have that connection be direct without Amazon taking its rent, which it does when you're trying to build a brand through Amazon.
Michael, I know that you at Assembled Brands, as you said in your introduction, spend a lot of time on direct-to-consumer companies. That's kind of the area of expertise. So what are you seeing?
Yeah, I think Billy hit it right on, where direct-to-consumer are getting a multiple of sales versus a multiple of Ebitda. And I'm seeing in my portfolio where we have a company in kind of beauty accessories type business that went from literally 0 to 20 million in the last 18 months. And they're getting a really nice multiple of revenue and a equity term sheet that's been verbalized. I haven't seen it. So, but I believe the guy, and, Ebitda is basically break even. And so you're finding this kind of bifurcation, right, where the direct play is just getting this huge multiple, and they are now expanding into retail doors for the first time. And I think what's interesting and what we've seen a lot is that if it's easier to transition from direct first into retail versus the other way around. And once you can, I think the future still is omni-channel. And to me, that's really 3 tiers. It's direct, Amazon, and brick and mortar. I don't think brick and mortar is dead. You kind of, at the very minimum, get a nice advertising bump, right? You just get more you get more eyes on your product at the very least. And so you make up for that with eyeballs, in my opinion. And that's what we've seen on some of the stronger companies in our portfolio. So, it's just interesting to see, and maybe, time will tell if these valuations are a little stretched, but huge multiple on sales for really strong growing companies. That's definitely the trend we've seen. And, I don't know how you can discount COVID bump, as we like to call it, but it doesn't seem like there's much discounting yet. Maybe it's still too early. And Dan and Billy, maybe you've seen something else, but I'd be really interested to see how that plays out, maybe even 6 months from now.
It's interesting. This COVID bump is a very frustrating question for me, in that it's kind of heads I win, tails you lose. Many transactions, people are saying if you had a good COVID, it's a one-time event, and I'm not going to pay you for it. But if you had a bad COVID, you're a failed business, and I don't want to buy your business at all. And so it's damned if you do, damned if you don't. Increasingly, we are, every day putting kind of the pandemic in the rearview mirror. And we are more and more kind of, showing monthly type data. Now, March 2020 was a little bit of a hybrid month. The world kind of came to a screeching halt mid-month, but the first couple of weeks of March were quasi-normal a year ago. So I think that increasingly we are trying to benchmark by putting COVID in the rearview mirror. But again, it is very, very hard because people are confused on how to value that.
Great. What I'd like to do now is, before moving to our next topic, to do one of our polling questions, which I will ask either Lena or Marisol to put up. And that is, what types of companies are likely to see the most M&A activity over the next several months or through this year? So we've got 4 different choices here. So this is types of companies. 1, distressed. And distressed, I think we've heard referred to as The Walking Dead. One of our panelists came up with that, but I'm not going to provide attribution just because of the negativity. Second are COVID survivors, which have been described as the walking wounded. Third would be COVID beneficiaries, where 2020 was the best year ever. And then lastly would be kind of young emerging growth companies. So we'll give you 10 or 20 seconds to cast your vote, and we'll see what our audience thinks before we go to our panelists. Okay, so boy, this is heavily skewed. It looks like over half of our audience thinks that the sectors that are going to have the most activity, or the types of companies that are going to have the most activity, are the COVID beneficiaries, where 2020 was the best year ever. And that was, just doing the math, a larger percentage than the other 3 combined: distressed, COVID survivors, or emerging growth. Let me go to Dan on this one. The next question that we have, will be, what will the M&A market be like for consumer brands that performed well during the COVID pandemic compared to those that performed poorly? You've clearly heard what our audience thinks. Dan, do you agree with that?
I do agree, but with exceptions. So I think Billy actually put it perfectly when he said, "You're damned if you do, you're damned if you don't." This question is a double-edged sword. On the one hand, if a brand had a great 2020 through e-commerce, investors are going to undoubtedly question whether that growth is sustainable. And I can't tell you how many conversations I've had over the past 6 months trying to analyze the sustainability of the COVID bump. And the natural extension of that conversation is trying to then determine what is a normalized level of earnings to value. Factors that we're considering are, like we were just discussing, is the bump driven by sales through the company website or an e-tailer like Amazon? We'll look at marketing spend over that period and try to analyze customer acquisition cost, return on advertising spend, to determine whether the positive trends of those outperformers are sustainable themselves. And we'll also look at how are you doing relative to your competitors in the same sector. Is it an issue where a rising tide of COVID is lifting all boats in your sector, or is your brand taking share? Obviously, the businesses that can prove that they're taking share will garner the higher valuations, and in some cases, the revenue multiples that Billy and Michael referred to. But I think it's safe to say that if you did great during COVID, investors are going to be somewhat skeptical. And on the other hand, this is the double-edged sword aspect of it. If you're a brand who struggled during COVID, the walking wounded, as you call it, Richard, that's obviously not a positive fact either. And in that case, investors are going to spend time trying to isolate what are the drivers of that underperformance and analyze whether those are drivers that will persist in a post-COVID world. We're all seeing the light at the end of the tunnel with vaccinations, but there's still a lot of uncertainty as to what the new normal will look like, and investors need to place their bets wisely. One trend that we are seeing is both investors and brands being more open to structure in the deals. So earnouts, which typically I don't like, but sometimes, in this case, when there's been such a bump, it's just a natural extension of where you might end up, where you say, okay, I'll give you the value you're looking for, but some form of that is going to be based on, 2021 or 2022 results, because, we're all in the unknown part here. And you have to be willing to bet on yourselves as a brand the same way that I'm betting on you as an investor.
Great. Michael, would you like to comment? Because you've got a portfolio of brands. And I guess just from your portfolio, are you seeing the same kind of breakdown that the audience is suggesting in terms of activity relative to how you would bucket your particular companies?
Yeah, I think,
and things, new ones, and also new ones that you're seeing as well.
Yeah, I think, most of our companies I would classify as really emerging growth, for the most part, just being the nature of dealing with newer stage companies and direct to consumer. And so, we're very bullish on that segment. But when we look at kind of what the audience was saying, 2020 is the best year ever, I think there are things you can bracket out, right? So if you look at kind of the first quarter of COVID, that mid-March through, call it June or July, there was a dearth of competition on social media. So there was almost a social media ad spend arbitrage where if you were spending money, you were getting, instead of a 3-time return on your ad spend, which is like a pretty healthy, 3 to 4 is pretty healthy, you could get 10x, and it was kind of unheard of. And so that mechanism was just fueling sales for the companies that were active. So we saw anywhere between, call it 50% to 500% year over year for those months for certain brands in our portfolio. And it was just like our eyes were like wide open, like, wow, what's happening here, right? And so that was one thing, if you want to just kind of normalize ad spend, it really, I think closer starting, like I said, in late summer, fall, it kind of started to normalize where everyone kind of caught their breath and saw, okay, the world's not falling off a cliff. We can participate and start to focus on growth again. So if you want to, if you take those numbers with a grain of salt in the first half of COVID, first quarter, then also the effect of stimulus, right? And you see this everywhere. It's when there's a recession, but you see, subprime auto delinquencies at an all-time low, right? There's some huge disconnect. And I would say a lot of that disconnect also showed in e-commerce and emerging growth, right? Because if I'm just sitting at home and I'm getting stimulus checks, on a fairly regular basis, a lot of that money is going to go into these channels. So I think that's another thing that, investors have to discount. We haven't seen, in the handful of, I guess we've seen a few, what I would call quasi-distressed deals that were a little bit in motion, even like pre-COVID, those conversations were ongoing, that did close and, weren't a crazy multiple of sales. There were a few times Ebitda, and this is actually for mostly direct to a few companies that are mostly direct to consumer, but on the other spectrum, especially too in food and bev, I've seen wild multiples of sales, and I know food and bev is such a different beast, right? And it's hard to value that, but I think north of well north of 10x on certain canned beverages or certain emerging food categories that, right, it's kind of such an unknown that I get, people see those health segments and different trends and are really attracted to it. So, I'd say from an investor standpoint, there's a lot you can if you want to try and back into what's the proper valuation, there are certain levers you can pull when you're looking at it. And I'm sure Dan has, that's the exercise you go through on a regular basis. And so it really depends, right, on the segment and as well as what's your like total time period of looking at a company.
Billy, so you see lots of opportunities to take clients to market, and it's generally a relatively small percentage of what you see. But how does your deal flow, if you will, kind of line up to what the audience was indicating that they thought the market was going to look like in 2021?
So a couple of thoughts. One, everybody likes a good company. And I also think that there's always a market for a good company. So I'm not shocked by the response. I think the rubber meets the road on, okay, so who's willing to pay for a good company? I think what Dan was talking about, and people are pricing in uncertainty, and if you're selling options, volatility is a good thing. But if you're buying a company, uncertainty is a bad thing. A company that blows away its budget on the upside by 30% may not be a great company because management can't control it. So I think there's that dynamic. A lot of what we're talking about right now is, and this gets very much to Michael's point about 10 times ad spend returns. Who used COVID as the most profitable new business generation, marketing tool ever? And the question is then, what do you do with it? We're working with a company today. If they have 50 customers, they lost 40 of them, or the 40 of them greatly reduced their buy, but they picked up 50 new customers. And the question is, how many of the new customers are staying with them, and how many of the 50 come back? A lot in both. So they have a much better business model now, and they happen to do it very profitably. So I think that's going to increasingly be part of the conversation. I also think that, we are seeing a fair amount of distress, whether it is, a owner throwing in the towel. It just was, I got to the other side of the river, but it's too hard. Whether it's a strategic saying, you know what, I'm not being valued properly, so let's clean house and get rid of some things I just don't need anymore. whether it is, someone financially under pressure that needs a solution. There are distressed buyers. It's just a different universe and a very, very different valuation parameter. The problem there is, things just get worse with time. So a distressed asset is only going to decline in value. But fundamentally, I'm not surprised by the audience. I think the follow-up question, though, is where's fair market value?
Perfect. So let me go kind of to the next question, but just we've addressed, I think, some of it. The question is, what are expectations for baseline EBITDA assumptions as well as valuations in 2021? So Billy, I'm going to turn to you, but I want you to address a specific part of this, if you don't mind, and that is valuations for 2021. You alluded to this a minute ago, but I think a question is, buyer, what's a buyer willing to pay for, and what are sellers' expectations like in 2021, and where do you see there being a disconnect?
So let me answer that focused on what I would call as well-performing businesses. In a well-performing business, the sellers have not really changed their view from 2019. I had a good company. I did well in 2020. I still have a good company. Why am I no longer worth what I thought I was worth before? Whether that's 8 times EBITDA, 12 times EBITDA, or 3 times revenue. I'm still a good company. And again, where I think that disconnect, and again, there may be buyers, there's some we're seeing that are willing to say, I think it gets a little bit to Dan's point of structuring a deal. Okay, I'll give you your value, but on certain conditions and terms. I think that where the disconnect is pricing in the risk. And whether that risk is sustainability of the new higher profitability or revenue, whether it is what happens when a pandemic goes away. I mean, I think I want to make a tangential point on one of Suchatra's charts that showed different green bars where people were buying and red bars where they weren't. And clothing was the worst of it all, down 25. It's a huge number. But in the next 12 months, you're going to be going to weddings on Tuesday nights and 60th birthday parties on Wednesday nights. You're going to be out every night of the week. Some of that's going to reverse itself. So I think that where buyer and seller expectations are not meeting is in some of that. If you were selling outdoor heaters for your backyard, you're going to pitch me that says 22, 1, 2, and 3 will be just as good. I don't need more backyard heaters. If you're selling, wedding mother of the bride dresses, you could have the next 2 years could be the best of your company's history. So I think the disconnect is a combination of this risk assessment, but also people's expectations of changing demand and needs in the coming 24 months.
Yeah, it's a great point, Billy. And the thing that I kind of really clung on to that you said is about, well-run companies will rise to the top. And one thing that we look at when we're trying to analyze the COVID bump is, let's go back to what was your budget for 2020, the end of 2019. That was probably, to the extent that you can control the controllables, that's where you thought you were going to end up. Everything on top of that, or a good portion on top of that, is likely just, a little bit of luck with the wind at your sails. Similarly, as we're looking at businesses now, you tend, when you're in an investment process, to kind of really get to know the company over, from beginning to closing could take 3 months, give or take. And so really trying to understand, how is the business performing relative to their budget? How good are they now in this environment at predicting what next month's sales are going to look like? And even if it's at their unsustainable levels, a good manager has figured out to adapt to the current environment and can accurately predict where they're going to be. And the groups that are a little bit, deer in headlights, like, well, I don't know, what's next month going to be? Last couple of months have been growing at 50%, so that must be what the next group is, and they're just taking stabs in the dark. Those are tougher managers to get behind because, you know, like you said, Billy, no investor, what scares investors more than anything else is uncertainty.
Perfect. I'm going to let's skip to I want to skip to the next, our next question was going to be on how deal structures needed to adapt themselves. And I think we already had some good conversations around earnouts and Billy talking about pricing in risk and some of Michael's comments as well. What I'd like to do is go to the next polling question, and then go to the absolute last question, take a couple of questions from the audience and then wrap it up. So if we could have the next polling question, that would be terrific. And so this kind of gets at what sector do we think will be the most attractive for M&A activity in 2021? These are very broad sectors, but consumer goods staples, think of those as kind of the everyday essentials, if you will, as well as non-durables, as well as durables. Consumer goods discretionary, so things you don't need to have, but might want to buy. Retail how's retail going to do? And then there's a mix of stores and online. And then lastly, kind of a big group of travel, leisure, restaurants, things that are experience related. Which of those sectors do you think are going to be the most attractive in 2021? And then we'll turn to our panelists. Okay. These are actually, I find this kind of interesting. Consumer goods staples and consumer goods. So people are really going to think that the goods sector, if you will, whether it's staples or discretionary, 40% each. Really small percentage on retail. I guess retail is still in the doghouse. And then travel leisure, looks like 15% on travel, leisure, and experiences. Well, let me turn to our panelists and ask them, what do you think, and are some of we'll just characterize this a little differently, are the most and least attractive sectors for M&A? And again, I think people are going to be thinking a lot about Sucharita's slide, and Sucharita, we'll ask you to weigh in here at the end from your perspective. Why don't we start with Michael?
Yeah, I think, consumer discretionary it's such an interesting category to me, because to me, that's a lot of stimulus dollars goes into that. And so I think there's still if I was a buyer, was the discounting necessary to take that out of the equation? I think that would be a big question on my mind. I think if you look at the counter cyclicals like travel and leisure, I think that will have a huge lift. And I'm starting to see, we've had a few companies in our portfolio that are kind of expert travel apparel or travel accessories, and obviously they got crushed, and now they're starting to slowly tick back up, right? I think you saw the highest numbers in a year at TSA screenings this past weekend.
Yeah.
So I would actually be bullish if I was, on the counter cyclicals a little bit, and discounting discretionary, because discretionary is, I just don't know how, if you're a direct to consumer brand that's growing 3x from COVID, how do you grow another 3x? And I think that goes to the strength of management for sure. But, you basically got a free customer base through COVID. And if you can't take advantage of that, then shame on you. And you better take advantage of that, or else if I was an investor, I would crush you for that. So, I think there's some discounting that needs to be done there. And some of these counter cyclical is going to be a big segment. And I think that's where I would say quasi distress should do well. is in those segments.
I agree with you, Michael, but I actually reject the premise of the question a bit. It's a loaded question, right? Because the question is, who's going to do the best from an M&A standpoint in 2021? So first of all, as an investor, unless you're a public markets investor, you're not buying only for 2021. And so, the short-term trends that I think were identified in those in that chart isn't really how we underwrite deals, because we tend to own our investments for give or take 5 years. And so, understanding the sustainability of a brand is extraordinarily important, or of a sector. And the second part, reason that I reject the question, Richard, sorry, is what does 2021 mean? We're in March, end of March, and we're still under COVID. So if I'm investing just for 2021, what does that look like? Am I thinking, is that a second half question? Is it, at what point do people start to feel comfortable, travel, go to stores? It's not happening yet, although it is starting. And I think that the examples you gave, Michael, TSA screenings, all that's starting to pick up. Forward-looking trips are doing well. We own some investments in the travel and leisure space, and second half is based on bookings is looking pretty strong. But all of that is subject to lots of things that are out of our control. Is the government going to get a shot in everybody's arm? And when people get the shot in their arm, does that mean okay, back to normal, or is there some lingering effect of this past year that will stick with people? So it's just tough to look at 2021 in isolation and try to figure out what that means for the M&A market.
Yeah. Billy, how about things that you're seeing?
Look, I know it wasn't
And you want to bring to market?
I know it wasn't totally the question. I think beauty and personal care will continue to be in high demand. I think that good for you, healthy living, food and beverage will continue to be in high demand. For the one person who voted on retail, please give me a call. I actually believe, a little bit to the charts that were shown, physical retail is not going away. And if it's a established, good cash flowing company that's not overstored, that has kind of reasonable lease portfolio that you could buy at 3 or 4 or 5 times EBITDA, it's a great trade. So I think there's a way to approach physical retail investing. I think you have to be very cautious when you're looking at these true DTC, Amazon or not brands. Again, they could be phenomenal, but I don't know that they're worth 10 times revenue. 4 times revenue, maybe, but are they ever going to be profitable? And I guess on the consumer durables, again, when I hear that, I go back to my backyard heater. How many more of them, even if I'm going to be eating outside for the next 3 years, how many more heaters do I need? So again, I think it gets back to a good company is a good company.
I would just add
Right.
that we used our backyard heater one time here in Los Angeles over winter. So, great investment on my behalf.
I bought 3 heaters, and they're in terrible condition because the northeast winds blew them all down, and now they look bent and disgusting. So I may, in fact, be in the market for more heaters.
There you go. Sucharita, you want to give us your view on this? Last word.
I was surprised that the number of emerging companies, the speculation around investment M&A activity there was as low as it was. It just seems like there's so much investor dollars and interest in those emerging Amazon and big commerce Shopify players, and they want exits too. I mean, these are little entrepreneurs that are willing to cash out, and if you can buy a great business that you can grow and scale, more power to you. And I also think that, like Billy, I think that maybe some people are underestimating the amount of M&A activity that will happen in retail. I mean, we didn't talk a ton about how much debt retailers have taken on in the last year to stay alive, and they need they need a path to, kind of some kind of long-term longevity, and scale and partnering with other companies seems like a way out of that.
Terrific. Before we go, we're a little bit over time, but there have been a couple of questions, short questions. I'd love to just get them to the panelists that are coming from our audience. The first is, what % of revenue needs to be DTC in order to garner a multiple on sales versus Ebitda?
I think on this one, I don't remember whether it was Michael or Dan. I think it's less about a hard percent and more about, are you a digital first or a physical first? Warby Parker has spectacular stores today, but those are profitable marketing, ultimately driving you back online. So I think it's more of a mindset. I love that Macy's does 10 billion or more than that online, but they're going to be valued as a physical retailer first. So I think it's more kind of, how did you originally approach the market more than percent? That's my take on that question.
I think that's a good one. Let me go to the second question again in the interest of time, because I think most people would kind of nod their heads, most of our panelists, on your answer, Billy. Do you feel the DIY movement, so this is the Lowe's and Home Depot types, do you feel the DIY movement has been permanently elevated, or do you anticipate a return to pre-COVID trends? Sucharita, I saw you nodding your head. Why don't you take that one?
Yeah, this seems like it's an unusually high burst that was driven by a bunch of people who are staying home. When people go back to work, they don't have time. We saw even things, everything, from Clubhouse, the app, to, collectibles, all of this exploded because of the time that we have. That's going to go away.
I think, anyone disagree with that? Otherwise, we'll have,
I
go
only
ahead.
slightly disagree in that I think it will be elevated from what it was, but there will be a reckoning where it does drop back to somewhat more of a normal level. But, if the new normal, in fact, turns out to be you work from home 2 days a week, when you're sitting at home, we all realize is when you start to, the DIY ideas come into your mind, or your spouse is close enough to you on a regular basis to tell you, hey, you better start fixing this. So I think there will be an elevated basis of, beyond what we saw in 2019 and before, but certainly it's not sustainable at the levels that we've seen recently.
I think that's a good asterisk. Lena, I think this has been a terrific panel. Thank you guys so much. You really did a great job, and I think hopefully our audience will appreciate all of your comments. Lena, you just want to kind of wrap it up here?
Yes, thank you, Richard, and thank you to our panelists. Great discussion. We sincerely appreciate your contribution. Thank you to our audience. We hope you found value in today's discussion. We will be posting it to our YouTube channel in the next day or so, so stay tuned. A ton coming up. Another webinar, tech software coming up in April. We have a fireside chat with TriNet's CEO. So stay tuned. We'll be sending out more information. If you are participating in today's Deal Connect one-on-one meetings, please log out of this link now and log into the separate link that was circulated yesterday. If you need any help, don't hesitate to reach out. But thank you all for joining us again, and we hope you all stay healthy.
Lena, one last question, and that is Sucharita's presentation. Will you make that available to the participants?
Yes, if Sucharita is okay with that, I'm happy to share it. Okay, so if anybody would like that presentation, please feel free to reach out to me directly. My email is there. But again, if you're participating in the Deal Connect, log out of this link, log into the separate one. Again, thank you to our panelists, Richard, for leading the discussion and putting together such a great panel. We look forward to seeing you all soon. Thanks, everyone.
Great.